Welcome back. You're still tuned into Power Breakfast on CNBC-TV18. Well, let's talk about the mutual fund space because there is a big update there. It's a blow to debt mutual funds because as per the proposed amendment in the Finance Bill 2023, the mutual funds who invest not more than 35% of their holdings in equity shares will now deemed to be short-term capital gains. What it means is if a mutual fund is not investing more than 35% in any of the funds, that would mean they are investing in, say, debt mutual funds, gold, or any other category. Now any gains from those will be taxed under short-term capital gains. This applies to all the investments made on or after April 1, 2023. Now what would the categories be which would be impacted? The debt funds, because majority of the portion goes into bonds or, the debt side, international funds, and also gold funds as well. Now the current tax structure in these three funds is short-term capital gains. They are taxed at the slab rate, whichever is applicable to an individual. Long-term capital gains, which is when you hold an asset for more than 36 months, there it is taxed at 20%, and also indexation benefit is available. And that's the reason why people invested in these funds. But now the proposed amendment says that if debt mutual funds are held for more than 3 years, they will no longer enjoy the indexation benefit. They will no longer be eligible for this 20% tax rate as well. Additionally, grandfathering will not be extended to market-linked debentures. They already saw market-linked debentures, that is another tax regime in the budget, and this is an additional blow that has come by. So, of course, these funds will be in focus, and we'll be discussing more on that. In fact, let's get in Pavitra as well. Pavitra, what are the experts saying about this?
Oh, Sona, like you were pointing out, I have been talking to experts through the morning and everybody agreeing that this is a big blow to debt mutual funds. In fact, not just debt mutual funds, this applies to gold and international investing as well. So, that is going to be hit as well. And, experts saying across the board that one of the main reasons to really invest in debt, in gold or in international funds was, in fact, the indexation benefit. And when you remove that, of course, that comes as a big blow. So they think that money will now flow to sovereign gold bonds and maybe back to FDs and NCDs as far as the debt category goes. In fact, speaking of the indexation benefit, it's not only that is lost, but they will also be taxed at a marginal rate. So that is something that we need to keep in mind. Also from experts, and this is something that we do know, that retail investors are not that big in the debt category, right? It is mostly institutions that are larger clients, so that those will be perhaps more heavily impacted, and also the HNIs. So that is the part of the market that could see perhaps more of an impact, but across the board, everybody agreeing that this is a huge blow to the debt mutual funds.
Oh, it is, of course. Petra, thank you so much for getting us all those details, and we'll keep discussing what the impact could be on the industry as a whole and these categories in particular. For now, we have run out of time on this edition of Power Breakfast. Do stay tuned. Bazaar Morning Call comes up next.